Hello and a warm welcome to Talking Stocks. I'm Gugulethu Cele. In studio with me is Peter Armitage and Sean Ashton, both from Anchor Capital. Today we're talking Reinet Investments, a Luxembourg-based investment vehicle that was demerged from the Swiss luxury goods company Richemont back in 2008. It is listed on the Luxembourg Stock Exchange and at 2014 was the largest component of the index in that particular region. Maybe let's get a quick refresher on this particular company. I think it's because sometimes when you talk about an investment holding company, people tend to not really understand the nitty-gritties of its operations. Sure.
So I think what you're effectively buying is a fund. So it's, as you mentioned earlier, this business was created as an investment vehicle using the spin-off of the BAT shares that Richemont held in 2008 when they demerged into a luxury goods business and a tobacco business. So effectively, Reinet itself was seeded with British American Tobacco shares, and they've steadily been divesting slowly of those shares and creating other investment or making other investments and building a more diversified investment holding company. But it's important that what you're ultimately buying, the only asset that Reinet Investments has is Reinet Fund, which is a fund. So you don't have a whole head office structure underneath this. That's a very key point to make, which means that the cost drag is not as much as people may imagine.
Would that be a benefit versus its competitors then?
Sure, it's certainly a benefit versus something like a Remgro as an example, where you've got a head office that you've got to feed.
Luxury goods though, one always thinks China was the growing market, but given what's happening in that particular environment, is this still the case?
I don't think it's really relevant for Reinet itself, because what they really have now is British American Tobacco shares. That's about 70% of the NAV of Reinet. It used to be about 88% when you look back over the last few years. So it's been diversifying. And then there's a business called Pension Corporation, which is a UK-based company that effectively insures large corporates against their defined benefit, or hedges out large corporates' defined benefit pension liabilities that they have. So quite a big theme towards companies wanting to get that stuff off balance sheet. And these guys obviously are well placed to grow their business in that space. So that's about 15% of the NAV of Reinet. And the remainder is really a bunch of private equity investments that they have, which have been growing quite strongly in recent years.
Would you be worried though about the over-reliance on BAT?
So I think you've got to look at the history of this company, and it was met with a lot of skepticism to start with, because effectively you've got, it's the whole Stellenbosch kind of portfolio that gets together, and you've got Richemont and Remgro and then Reinet, and all three very big companies. And Reinet was kind of the place for the Rupert family effectively to house its British American Tobacco shares. And what they made clear over time is that if they thought it opportune, they would sell down the British American Tobacco shares and buy the assets. I think what disappointed the market quite a lot in the early days was how slowly they moved. So Johan Rupert obviously has exposure to lots and lots of different investment opportunities around the world. And I think there was an expectation when it first listed that 50% of it would be other exciting business within a time period. But if you go back and look at the history of the way the Ruperts have operated back into the early days of Anton, and certainly if you look at Remgro over the course of the last 10 years, they move pretty slowly. They make deliberate investments, and they think very carefully about what they do. And they'd rather make one acquisition every 2 or 3 years rather than kind of re-energize it. They went through a phase a little while back where they had some technology type businesses and were a lot more active. That didn't work for them, didn't work out so well. So I think they're back to the Rupert value creation style over time for people, and that's worked. So initially, you were kind of buying really British American Tobacco and another shell. But I think the story really is one of that will become a lower proportion of Reinet as you go forward, and that can happen two ways. One, British American Tobacco coming down, like selling off and investing in other things, or using more debt to buy the assets. So the mix will change. And I think the thesis and why we've become quite positive on it recently is the implied valuation of the businesses other than British American Tobacco is fairly attractive.
So that would be the private equity and the pension space that you alluded to. Yeah. On this, though, it does seem as though it's had a positive impact on the net asset value, which has also managed to grow quite substantially, despite not being an acquisitions monster. I
mean, if you look at the growth in NAV, published directors' NAV for the non-listed stuff, in other words, everything other than British American Tobacco, it's been rising at a compound annual rate of about 60% in the last few years. So very, very sharp growth in NAV of the unlisted stuff. And I think the thesis for expecting outperformance from something like Reinet has got to be, because what is your performance going to be made up of? It's going to be what British American Tobacco does in terms of its growth and its share price, as well as the growth in the other assets that comprise the portfolio, together with what happens to the discount that's applied to that overall portfolio. So if you look over the last few years, Reinet has tended to have traded at a discount of anything from 25 to 30%, quite high discount to some of the parts as an investment holding company. And I think the reason for that is people have said, well, you've got a performance fee of 10% of performance that's applied to the portfolio, a 1% management fee. So it's almost like a quasi hedge fund type of fee structure. Yes, you don't have head office costs that create a drag, but in essence, you're buying British American Tobacco, which I can go and do myself, right? So the market's actually placed a fairly punitive discount on the assets that they earn relative to the fee structure. But we think that as the unlisted portion grows, those become scarce assets that people can't buy elsewhere. You know, you can go and buy British American Tobacco, but if you can't directly go and buy a pension corporation, as an example. So as the unlisted portion becomes more and more important in their lives, we would expect that discount can potentially narrow quite meaningfully.
On the pension corporation as well, you've got an interesting graph as well, which highlights the growth potential that could come out from there.
Yeah. So I think the interesting thing about this business, the way they valued it, so they're valuing it at a slight discount to embedded value, and the implied value lands up being about an 11 times P multiple. But we expect it to grow by at least 20% next year. So forward 9 PE for a business of this nature in an industry, in a space where I think they can gain a lot of market share. And just thematically, a lot of big corporates that have defined benefit plans are wanting to convert that to defined contribution and hedge out that exposures. And these guys are very well placed to take advantage of that. So I think there's upside to their valuation that the directors have applied. And we wouldn't be surprised to see a listing of that asset at some point in the future.
But given the long-term growth potential here, I take it you're not buying it for the dividend then?
Not especially so. I mean, we would be buying it for above average growth in the intrinsic value of the assets they own, together with an unwinding, to an extent, of the discount to the sum of the parts that's applied now. So in other words, when if the asset's worth 100, the share price now is effectively, let's say, about 80 or so, maybe 72, because there's about a 28% discount. So that 100's going to grow, but we also think that discount will narrow, which can create a bit more performance for shareholders.
But Gugu, 2 big points. I mean, number one, you've got to have a positive view on British American Tobacco about this, because obviously it's 70-odd% of the value.
Well, hey, that's one of those sin stocks that always performs, right?
Yeah. So I mean, that's we think that's a reasonable asset. Huge cash flows, big dividends. I'm not sure I'd want to own it on a 10-year view. They grow their earnings quite nicely, but their volumes tend to go down every year. Now, that eventually catches up with you. They're managing to create premium brands, increase pricing, and in fact have impressed significantly and done better than I expected over the last few years in earnings. And it looks pretty solid going forward. But if your volumes are going down 1 or 2% every year, eventually you get to a point where you can't carry that on forever. And the second point is this is a foreign asset. So for South African investors, there's always, guys always want quite a bit of non-rand exposure, certainly at this point in time, and it looks like for the foreseeable future in your portfolio. So this is and also when people buy foreign assets in South Africa, they tend to view it as kind of a nest egg type asset. It's kind of protecting against the currency, protecting against your local assets from a currency point of view. So people tend to want to own quality, and certainly, the Rupert family and Reinet in this instance, the same with Richemont, the same with Remgro, it tends to have an aura of quality about it, and Reinet offers you that foreign exposure in quality businesses with conservative investors.
Versus its competitors, though, we mentioned Richemont earlier on in the show. I take it the benefit share is that it doesn't necessarily deal with those luxury good items, which depends on consumers, right?
It's a very different business. I mean, I think to call it a competitor to Richemont is probably not right. It's in a totally different camp. They're an investment holding company. I guess it's more similar to a Brait.
It's an alternative.
It's an alternative to Richemont, but probably a lot more comparable to a Brait. And I would expect them to, I think in terms of the profile of how they do things, they're probably a lot more conservative than a Brait. I wouldn't expect them to have the same kind of gearing structure in their underlying assets than what Brait will have. So expect them to be a bit more slow, a bit more measured, a bit more deliberate in the types of things they do, which may mean shorter term underperformance, but I think that it's a quality asset.
The share price at what, 29 Rand, looking at a PE of what, 4, so a lot cheaper than Brait, I take it as well.
Yeah, that's probably not the right way to look at it from a PE point of view, because what you often have with these investment holding companies is revaluation of the underlying assets, which forms part of earnings. So you'll note that Brait also trades at a very low multiple of reported earnings, but that reported earnings is not the kind of sustainable underlying earnings number of the underlying businesses that they earn. So the PE multiple actually is a lot higher than what that is. That's not a figure I would focus on too much. But the way to think about it is, if you look through into the underlying businesses that they own, you've got British American Tobacco, which probably trades at mid-teen forward multiples with a 3 or 4% dividend yield, and that's 70% of what's driving the value of Reinet.
Well, let's get the analysis from our experts now. Buy, hold, or sell Reinet. Peter, buy, hold, or sell the stock?
So I think if you look at a portfolio and portfolio construction, which as an asset manager like an Anchor Capital, it's not just a list of buys and sells, it's a mixture of a portfolio. And this fills a particular role in the portfolio, and we'd call it a buy from that extent. So a good quality base share in your portfolio, it's not going to race away. It's not going to be your high flyer 30-40% return per annum, but it's a nice rand hedge. And it gives you quality exposure, and you can be comfortable that it's a fairly low risk asset. So it's a buy in the context of a base share in a portfolio.
I take it you agree, Sean?
Yeah, I think that sums it up pretty well. So I mean, it's very easy to call it a hold, because it's something that you're going to sit on for a while. But I think I'm enthusiastic about their ability for the ability of the market to actually re-rate the share relative to intrinsic assets over the next couple of years. So I would call it a buy.
And you like the management team and maybe the potential growth that could come out from there? Perfect. Well, that's where we'll leave it for this week's edition of Talking Stocks. A big thank you to both my guests, Peter Armitage and Sean Ashton from Anchor Capital. And that's where we end things for this edition. Do join us again next time where we talk more stocks.
For the latest fundamental and technical analysis delivered right to your inbox, log on to talkingstocks.co.za and sign up for the Talking Stocks newsletter.